68% of SOL is in native SOL. You've got probably $1 billion of liquidity locked in things like Radium and Meteora. And so there's all this surface area of people that have these assets and can't do anything productively with them right now outside of their initial use. And so for us, as we continue to integrate these different platforms and different types of assets, I think we'll see a natural growth from that.
Mary Gooneratne is the co-founder of Loopscale. Loopscale is a lending protocol on Solana built to give sophisticated users more control over capital and risk.
Do you think a lot of people in the industry tend to go down that route of just like, we got to get it out quick, it's got to go?
The space moves quickly. You see announcements and new products every day. And so there's an inherent pressure with any company, and especially in crypto, to get new products out there, to support new assets, especially since that's kind of one of our big advantages as a protocol.
Today's guest is Mary Gooneratne, the co-founder of Loopscale. This is our 4th episode, a part of the Solana Sessions campaign that we're focusing on founders building in the Solana ecosystem. Loopscale is an on-chain borrowing and lending platform built on Solana and launched publicly in recent months. I'm excited to have Mary on the show today to talk about Loopscale and more. Mary, welcome.
Thank you. I'm excited to be here.
Excited to have you. We met at a Solana dinner a few months ago.
Yes.
And you were sitting across from me. And I found your background and story to be very interesting. Although you went to Duke,
yes.
I went to UNC. That's,
I recall that was, I think,
that
the
was kind of like,
after the
a deal
game.
breaker.
Yeah.
But can you start off and tell us a little bit about yourself and how you even ended up in this industry?
Yeah, for sure. So like you mentioned, I actually met my co-founder at Duke. We met on a comp sci group project, became friends, we both liked building things, and kind of were exploring a lot of different ideas in fintech and finance, and actually ended up reading kind of a book at the same time together called Machinery of Freedom. It's this like anarcho-capitalist manifesto. And I feel like that was really the pivotal moment for us in terms of like sparking our interest in just what are these alternative mechanisms you can use to better align incentives and improve kind of the economic system for all participants and improve coordination more broadly. And so we ended up building Bridge Split in late 2021, which has now become Loopscale in recent months.
And Bridge Split is Loopscale, or did you kind of pivot and change the idea?
Yeah, so we started Bridge Split originally with this idea for real world asset lending, and we were building like lending infrastructure for tokenized assets. So the easiest example is kind of our partnership with Baxis. And so we were doing borrowing and lending against literal like whiskey casks, but realized a lot of the infrastructure we had built and problems we were solving with this model still affected digital native assets. And we had inbound from users wanting to use LP positions. And so we spent a lot of time making order books work for DeFi, which has kind of historically been a challenge, and relaunched the protocol with a new brand late last year.
Okay. And then what made you ultimately want to land on building Loopscale? Even though there are other borrowing and lending platforms out there, what do you think makes you guys different?
Yeah, so traditional borrow lend is with a pool-based model. And I think for us, it felt like this huge gap in that kind of after you had Solana, you had this innovation in like spot and trading markets with Phoenix and Serum, and you went from Uniswap, which was this algorithmic approximation of markets, to these order book-based markets, which are how markets are coordinated in TradFi for a number of reasons, and they're more capital efficient and kind of a better way to structure markets. And with lending, we had the money market protocols, Aave and Compound, and then post Solana, you didn't see that same step function innovation that you saw with trading. And those are kind of those two core pillars of any financial system. And so for us, between having built this order book infrastructure and noticing all of the different problems across capital efficiency and restrictions, and there's really a big why now on Solana in that there's this huge proliferation of different types of derivative assets and LSTs, that it really felt like that was a time to make that leap from the algorithmic model for credit markets to the order book model.
And when you say algorithmic model, are you talking about kind of like the pool-based models?
Yeah, exactly. And so that's when you are borrowing and lending against a subset of protocol whitelisted assets. Risk is priced on the utilization curve and kind of protocol set on a per principal asset basis. And really the base primitive in those cases is this relationship between the borrower and the pool and the supplier and the pool. And you don't have this real notion of a loan that you do in TradFi credit markets. So you couldn't ever have like an under collateralized loan. You couldn't ever have like a bullet payment loan. And with an order book model, we are kind of moving that base primitive of a loan, which you even see with some of these V2s and isolated markets. They're still using this underlying pool, but replacing that with a bilateral credit agreement that you would see in traditional markets and replacing this risk pricing infrastructure that you have with utilization curves with an order book. And so with that, you're pricing markets on an individual loan basis effectively.
Mm-hmm. What would you say are like the biggest constraints today with the credit market and then also the DeFi lending markets when it comes to like bottlenecks and limitations that made you kind of want to start this?
Yeah, so the pool-based model is really, again, a function of Ethereum's technical constraints and the fact that there wasn't a proven demand for borrow markets at the time. And so you only needed it to support a handful of assets. There were like 12 liquid assets that were worth borrowing against to begin with. And now, 68% of SOL is staked SOL. A solid majority of that is in LSTs. You have Orca liquidity positions. And so you have all these different assets that aren't able to be productively used in DeFi as a function of a lack of kind of credit markets for them. And so one of the biggest limitations is you can't borrow against more than a handful of assets. And then another big constraint is this utilization pricing mechanism inherently creates this spread between the borrow rate and the lend rate, and leaves a lot of capital idle in the pools that could be otherwise used for borrowing. And then kind of the biggest constraint, I think, in this next generation of DeFi that we'll see is the pools don't have any sense of like institutional risk controls. So it's a one size risk model. And so as a institutional lender, you're not trying to delegate risk and return to either like a third party curator or a protocol, but instead you want to be managing what collateral you're lending against, what rate you're lending against, LTVs. And right now, none of those terms are customizable and rates are purely on like a principal utilization basis.
Why isn't it customizable?
So as a function, it's largely because of that pool-based model. And if you're aggregating all of the lenders and borrowers under this same kind of pool of capital, you're balancing a lot of different interests. And so someone invented this idea of the utilization curve, probably, I would guess, Aave with the launch of Aave after ETH Lend. And they said, this is close enough to the risk curve and risk pricing, and let's make it based on principal. And so that's just become the dominant way to price. And it gets you to an approximation that's obviously bolstered credit markets to the $1 billion in TVL that they are today. But I think they can be a lot bigger, and it'll kind of stifle things moving forward, especially as well.
We talked about this, you talked about Ethereum, and I want to kind of dive into maybe why Loopscale decided to build on top of Solana opposed to other chains. What was kind of the value proposition there for you early on and throughout its evolution from, let's say, when you first started building on Solana in 2021 to now? How have things changed?
Yeah, I mean, so we actually started like building on chain when Polygon was still in testnet. So first we were deploying contracts on Ethereum, but me and my co-founder, like I mentioned, were straight out of college and deploying contracts during like DeFi summer was $1,000 a pop. And we're like, okay, we can't really iterate here. And then we were exploring like the different L2s, played around in Polygon testnet, went to Bitcoin Miami in 2021.
I bet that was fun.
Yeah, and met Edgar and Barrett, who are still on Solana today, that was the first time we had heard about Solana. And I think for myself and a lot of the other builders in this space, the moment you start to kind of focus on Solana and never look back is the moment you start using the chain and you realize like the experience is just so much better, and you're not trying to do these optimizations and minimizing transactions. And so purely as a user, like after I installed Phantom, I was uninstalling other extensions, and it felt like this was definitely the way that users were going to be building. And the way users were going to be moving over the next few years. And so there might not have been a lot of liquidity in users then, but we felt pretty good that was where things were headed. And then from a developer perspective, we could do so much more with transactions being cheaper. Your design space to construct a financial product is so much bigger. And I think order books are one of those big, like only possible on Solana infrastructure pieces. And I think they're kind of the core of every efficient capital market. And so for us, it was, and while we later evolved into needing order books, there's nowhere else we could build our product kind of today.
Mm-hmm. Nowhere else? No other chains?
I mean, there's probably some of the newer chains, but we haven't, I mean, I think for us, and I've avoided being like tribalist, and I've always said, like, if there's a reason or a design constraint that like Solana could no longer support us, we wouldn't be like opposed to using another chain. But for us, it's every time we've wanted to build something, there's always been a way to do it on Solana. And then now over the past year, with like so many more users, so many more assets, there's kind of really no other place that there's a need for supporting credit markets across all these LSTs and things like that. So it's twofold in both the kind of, or threefold in what's possible, the assets on there, and now the users and liquidity on there.
Right. Okay. I know Loopscale also launched publicly, I believe, in the beginning of April, right? And in the beginning, things were off to a smooth start. And then there was an exploit of about $5.8 million.
Yeah.
Right? Do you want to kind of walk us through what happened there? I know the funds were recovered since, but maybe in the moment, what was that like? I
mean, it was awful in the moment. Yeah. So the exploit itself, which we were made aware of that Saturday, I think it's April 26th, was related to a specific pricing function we had introduced to support RateX PT assets. And so they offer a fixed yield asset. And so those have been the RateX and Exponent fixed yield loops have been one of our biggest growing products. And we had introduced this function to be able to liquidate those assets. And that function takes in a program from RateX to value the asset. And so in this specific case, the exploiter was able to pass in a spoofed version of the RateX program and offer an artificially inflated value for the collateral and take out a series of under-collateralized loans. And so that has since been obviously patched, and we went through a kind of re-review of the withdrawals code as well as a full audit of the entire program library with Sec3, and have since recovered the funds, and users have been able to withdraw, and we've reopened to app functionality. But it was definitely a learning moment for us. And I think with every protocol, you're kind of prioritizing between shipping speed and moving slowly, and kind of feeling the trade-off, of course, in that way, that intimate of a way has obviously changed the way we've now our deployment processes and what we're optimizing for and prioritizing moving forward. Yeah.
We could talk about security a bit in a minute, but at the time, I believe Loopscale suspended lending and protocol functionality, right? To kind of stop the funds from being moved in and out, right? What was kind of the decision behind that in the moment?
Yeah, so I think that's a common playbook post-exploit. So immediately after the attack, probably within 10 minutes, we had engaged with a SEAL war room. So those are a team of like nonprofit security researchers who were incredible and incredibly helpful during the event. But that was kind of their advice off the bat was you gotta just kind of are in a moment of vulnerability and aren't sure what the surface area is. And so it's best to just brick everything. And so we paused all protocol functionality until we had like the time to diagnose and review everything. And later that evening, of course, with borrow lend protocol, there's a lot of moving pieces and borrowers have health ratios to maintain to avoid liquidation. So we reopened repayments and topping up collateral on the app, which didn't involve any kind of withdrawal of assets. So it was a relatively safe function to reintroduce. And then over kind of the coming weeks, reintroduced withdrawals and then full app functionality.
Okay. In the process of getting the funds back, I feel like it's very rare for people to get funds back from hackers. And when I read that, I was actually, happily surprised for you guys and happy for the users and everyone else. But what was that process like, getting the funds back?
Yeah, so we again, really leaned on the different folks that had jumped in to help and had sent an on-chain message to the exploiter, I think the afternoon or the night of the hack, to which he responded. We kind of conducted negotiations via email, and we were able to work quickly with both law enforcement, exchanges, and different protocols where a lot of the funds were difficult to move pretty quickly post-exploit. And so that ultimately led us to a position where we were able to recover the funds from the exploiter, which, again, very grateful that we were able to kind of make users whole, and especially so quickly after the incident. I think it was probably like 72 hours after we had gotten all the funds back. And so definitely super grateful.
Do you know who the exploiter is then?
Yes.
Or entity?
Yes. We had announced that, I think last week or 2 weeks ago, that we had identified, just with the help of law enforcement, and some on-chain analytics. We had identified who the exploiter was.
Are they in trouble?
I am not at leisure to comment on that.
Okay, fair enough. With that happening, do you kind of wish that the launch happened later, or this was going to happen kind of regardless?
Yeah, so I think for obviously the best case situation is an exploit never happens. I think for it to happen at a smaller TVL and kind of early on in our journey, and teach us the lessons we needed to clearly learn early on before it was something with like Euler, where I think it was like a $250 million exploit, and there's no way to patch that hole even with like company or treasury funds. And so I'm grateful that it happened at the time it did. I'm not glad that it happened generally. If the vulnerability was there, I mean, it would have happened kind of either in closed beta. I'm guessing the exploiter was waiting until there was kind of significant enough TVL to make it worth their time.
Mm-hmm. Yeah. In a company post on May 19th, it stated the security incident was a test of the protocol and a test of the team, which I thought was an interesting and thoughtful way to word it. And before, you talked about kind of lessons learned. What do you think were the biggest lessons learned from the team?
Yeah, so I mean, I'm very grateful for our team, which, like me and my co-founder, they were alongside with us, pulling long nights to kind of make the resolution possible. But I think for us, the biggest takeaway is definitely around user security and OPSEC. And even there were all these different avenues we were pursuing originally with the investigation that exposed us to different things we could be doing better. And so for us, it's about not prioritizing growth and shipping new product as quickly as possible and making sure every single feature is audited, if not double and triple audited, before getting it out. And that slow growth is infinitely better than a risky fast growth curve in TVL.
Do you think a lot of people in the industry tend to go down that route of just like, we got to get it out quick, it's got to go? Yeah. And that's like a slippery slope, like you said. Exactly.
The space moves quickly. You see announcements and new products every day. And so there's an inherent pressure with any company, and especially in crypto, to get new products out there, to support new assets, especially since that's kind of one of our big advantages as a protocol. But again, it's a lesson that's hard to really realize the trade-off you're making in real time, because it just feels like, why wait like 2 months or whatever? But I'm glad that we learned kind of the value of waiting 2 months, both for just like mental peace and like knowing the longevity of the protocol, but also it's important in kind of protecting users and also earning back their trust after the incident.
In terms of security, you talked about auditing and double auditing and triple auditing. And I saw in the post from May 19th that there were new security improvements that were kind of maybe going to change the way Loopscale operates going forward. Can you tell us a little bit more about that?
Yeah, so there are a number of new things that we have both planned and in the pipeline, as well as are already live. And so one of the first like temporary security measures we took was introducing a back-end cosigner to the program, which what that basically means is the only person that can send transactions to our program or approve of them is us. So users are still in full control of their funds, and we can't initiate a transaction, but you could not construct a malicious transaction as was done in the original exploit. And so that was one kind of initial measure we took. And then after that, obviously, before reopening the full protocol functionality, worked with Sec3 to get a full audit done of of the program library, made sure that every kind of wallet and signatory related to our architecture was a multi-sig, and so a number of OPSEC improvements there and review processes. And I think going forward, a couple of new program changes now that are in the works are borrow caps and withdrawal caps and per asset caps, which I think will be the most meaningful change at an architectural level in terms of protecting users. And so now there's a delay, or there will be a delay for loans over a certain size, and it'll be limited by the asset and on a per borrower and per loan basis. And these can be configured at the vault level. So for a particular curator, if they are hoping to have like a more conservative risk profile, they can have that delay be several days or make the kind of threshold amount be significantly lower for like even $1,000 or $10,000 loan. And so these program changes combined with the different kind of OPSEC and kind of internal deployment process changes that we're making make me feel better kind of about the path moving forward.
Yeah. I think this segues well into what I want to ask next is about what do users want to do? Like, what is the biggest demand on Loopscale? Where do they want to borrow and lend? What products are you seeing the most growth for right now?
Yeah, so when we launched in closed beta, our kind of thesis was our product was best for sophisticated borrowers. And I still feel that way, that if you're kind of a lender that wants more customization over the risk profile, or you're a borrower that is actually kind of doing these hands-on strategies, you're going to be the ones that are more sensitive to better rates, more sensitive to more collateral options and liquidity. And so our initial power user groups were really these sophisticated borrowers and lenders. And so one big group was Orca LP, like liquidity providers. And so they were borrowing against liquidity positions and kind of doing these leverage market making strategies. And those types of borrowers definitely kind of brought us to the public launch and got us to the volume and TVL that we were looking for before the public launch. And now, though, as we've launched kind of two big products as part of the closed beta public launch, which was Loopscale Vaults on the lending side, which abstracts a lot of the complexity for lenders, and then Loops, which is a borrowing product that is also more one-click and user-friendly. We've definitely seen a ton of growth in those and kind of more retail, individual lenders and borrowers. And so our fastest growing product by far, by both like unique users and TVL, has been our PT looping product. And so the PTs, like I mentioned with Exponent, for example, are fixed yield tokens. And so if you're doing like a PT stablecoin loop or a PT LST loop, the combination of both Exponent's infrastructure and then our fixed rate borrowing infrastructure puts you at a place where you're earning, you kind of know your costs, you know your yield, and you're entering a pretty predictable agreement for some amount of time. And so those have grown a ton. Exponent is growing a lot as well. And so like the WFrag Sol loop, for example, has been growing a ton. So we're seeing a lot of usage there.
So would you say it's mostly retail users then, or do you see institutional interest at the moment?
Yeah, so we have a lot of institutional interest, as well as kind of these sophisticated whales is probably what I would term that term that market segment, where they are not necessarily just kind of passively depositing to protocols, but they're executing kind of more interesting strategies. And our infrastructure is really, again, kind of catered towards that institutional or sophisticated user who wants to participate in the liquidity and returns of the kind of internet capital markets. But right now, kind of on existing protocols, don't have either the risk controls or the rates or capital that they're looking for.
Is there a specific type of user that you're not seeing that you would like to see in the future?
Let's see. That's a hard one. I think something that we are more excited about is kind of what we did with Orca in terms of like leveraging that user base and kind of supercharging that user base. We definitely want to see more of those types of users across different types of protocols like Radium and Meteora, where people are kind of across all these different DeFi protocols and using Loopscale as kind of this cross-protocol margin and managing positions, even from within Loopscale. And so that's definitely a user segment we're excited about.
Right. I also want to talk about the Loop side of the product, or Loop side of Loopscale. I saw the all-time volume was about $1 billion at the time of recording. What do you kind of attribute to that growth, and where do you kind of see that volume going, let's say, by the end of the year?
Yeah, so I think a lot of it, like I mentioned, can be attributed to the loop product. You've got people pulling these levered loops on Sol and with market movements. And I think it's an especially interesting product because even like we had like that little mini bear earlier, I think in April. And the kind of advantage of a loop product is you can take out these like delta neutral strategies or just earn yield on stable coins without necessarily taking a directional bet. So that's been helping us grow volume regardless of whether people are trying to make these more macro trades. Hoping to hit 2 billion soon. We're just growing as quickly as possible,
right.
And adding kind of new assets and new loops. And the exciting part for us is there's just so much idle liquidity really in Solana. We had a native stake Sol product, for example, and again, like 68% of Sol is in native Sol. You've got probably $1 billion of liquidity locked in things like Radium and Meteora. And so there's all this surface area of people that have these assets and can't do anything productively with them right now outside of their initial use. And so for us, as we continue to integrate these different platforms and different types of assets, I think we'll see a natural growth from that I'm excited about.
Yeah, when it comes to tapping into Solana liquidity and all these different asset classes, what are the other use cases and products that you would like to build on Loopscale?
Yeah, so like I mentioned, one of our big advantages is this idea of the base primitive being this bilateral credit agreement, and users on the front end can only see kind of a very small subset of those parameters that we've exposed because I think the current market today doesn't care about like setting a payment schedule. And so it's constructed to look more like a DeFi loan. But if you have any sort of like trade receivables product or real world asset financing, a lot of those parameters become relevant again. And so for us, I think the longer term vision, even with Loopscale, is all of these credit products in TradFi. And kind of as we see institutional interest grow over the past couple of months, I think it's not only institutional assets coming on chain in the form of like different BlackRock and securitized assets and like the ETFs with assets going off chain. But I think we'll also see an infrastructural bridge where we have more of the products that are off chain being actually run on the rails of crypto. And so to make that happen, you need something that is more flexible and scalable than kind of previous solutions. And so that's kind of where we see the long term. And so we've been talking to a number of these different players tokenizing different real world assets. So whether that's like Etherfuse or Alpha Ledger that are introducing these tokens. And so excited to support those on a collateral basis and also introduce kind of new loan structures for those products as well.
Yeah. When it comes to doing things on-chain finance, that's something that we've talked about a lot on the show. We have had a number of players both on the TradFi side and the institutional side kind of discuss what they want to see done. With the conversations that you're having, what are you hearing that institutions want to do on-chain?
Yeah, so I think there's definitely an interest to like create that bridge between TradFi and DeFi that doesn't exist right now, even with the different products we've seen launched, is that it feels like they're two very different user segments and that you don't see a lot of the kind of tokenized fund proliferation yet, like on chain. And so there's actually been, I think, a lot of interest, especially kind of under the new administration, in integrating those assets more deeply with TradFi. And so we've talked to a lot of these players about doing like looping strategies with these tokenized funds. And so that definitely, I think, increases the likelihood and growth of traditional markets coming on chain as much as these two things can merge and eventually become one. And so excited to see kind of that motion from those stakeholders.
With everything we've talked about, Mary, in terms of the credit market side of things, where do you see the biggest opportunity for Loopscale to grow?
Yeah, so I think the biggest, TradFi credit markets are huge, and between all like repurchase agreements and receivables, like I mentioned, invoice factoring, there is kind of a ton of surface area where both DeFi can replace existing rails, but also most importantly, I think it's about enabling new credit issuance. And with DeFi, you're able to introduce enough transparency and visibility into the process that de-risks a lot of credit products that are probably unsustainable or can't really necessarily function in TradFi. And so for us, the exciting thing is about creating this global credit markets layer where more people have access to credit, more businesses have access to credit, and at better terms than were previously available.
What do you think the time frame is for us to hit that global credit?
Slowly and then all at once.
Okay.
I think, I mean, this past year, I think this administration has been like a kind of the changes after this administration, we've seen kind of like crazy growth even in these first 2 quarters. And so I imagine that pace will continue. And so it's hard to forecast exactly what will happen over the next year or two, but I imagine we'll be in a pretty good spot in a few years.
Accelerating.
There
we go. Last thing, Mary, what else are you watching right now that you think others should pay attention to?
Can we edit out this pause while I think about this? Okay. I'm trying to think. And are you looking for like protocols or
anything that we haven't already discussed? Like what else is like piquing your interest?
Okay. And can I do something like Loopscale related? That's a little bit of a plug. Okay. Cool. I'll go for it. And so one thing we're excited about that's kind of coming soon, I think will lead to a broader growth in the DeFi ecosystem was a product we launched at Accelerate, which was sponsored vaults. And so that allows any team to basically launch a credit fund at zero marginal cost, whether that's a $100,000 fund or $1 million fund. And right now protocols are kind of stuck in this catch-22 where more growth requires more credit, but to get added to like a pool-based protocol, you're looking at a governance process. So excited kind of for this sponsored vaults product to roll out and for us to see credit markets across all these different kind of both niche asset classes and bigger asset classes as well.
When is it rolling out?
The sponsored vaults product is live. Our first vaults are probably going to go live end of June, I would guess.
Okay. All right. I guess we got to pay attention to that.
Indeed.
Last thing, Mary, can you leave us with a piece of advice, something that you've carried with you throughout your time in this space?
I think one piece of advice I have is to talk often and to many founders. I think it's easy with the news cycles and what people choose to focus on to become disillusioned with different parts of the space. But I think if you like go back to the people and the people building, it kind of restores your optimism every single time. And I think especially coming off of a conference, for example, always kind of reminds you of that fact that there's a lot of people doing really cool things in this space and motivated by something kind of larger than themselves.
Yeah, that's what we do on the show. We bring them on.
Thank you for having me.
Thanks, Mary. Appreciate it.